Hey, well, good morning to you all. Thank you for joining us on our first alternatives update for 2024. Today we're going to have Michael Houghton, Chief Investment Officer and Portfolio Manager of Lucerne Alternative Investment Funds, provide you an update on the always topical, always informative alternative side of your clients' portfolios. We will have question and answer time at the end, so you're welcome to send them through on the Q&A box. If you just click on that little link, you can send questions through. Other than that, we'll just hand over to Michael and give you your update. Thanks so much.
Thank you, Alva, and good morning, everybody. As Alva said, the first one for the year, so it's actually a really interesting time to talk about it because it gives us an opportunity to reflect on last year as well and some of the key things that are going to probably feed into this year. However, I do need to highlight the all-important content first and foremost. And once you've had a chance to read that, we'll move through to the next slide. Everybody's finished. Okay. Just as a refresher, why use alternatives? You've heard us talk about this before. I'm sure you've also got some thoughts about how it can fit into your portfolios, but basically, it gives you a wide universe of opportunities, much wider than a traditional market allocation to equities, bonds, currency could give you. But it also allows you to really exploit a thematic, and that thematic doesn't necessarily have to be something that you would traditionally think of, like very topically AI. You can exploit other thematics in different ways using the sorts of markets that maybe investors don't ordinarily get to see or access, but still get quite significant alpha from them. And the third thing that alternatives do, and we find this a lot, and also talking to people like yourself in the market, you find it as well, it does improve your conversations with clients. It's really good to be able to talk about some of the different esoteric or idiosyncratic things that you're doing in their portfolios to preserve capital, to drive alpha, and also remove some of that exposure to what has been a very interesting 2 years with 22 and 23. And obviously, our expectation with alternatives is that it will smooth returns. So an allocation to alternatives in a portfolio should see returns from the alternatives allocation, particularly with the fund that we manage. You'll probably notice that there's not a huge swing in performance over the course of a cycle. And in fact, it's probably one of the few conversations that you need to have when markets are challenging. And of course, even I can't drive the technology. There we go. So I said I thought it was a really good opportunity to just look back at 2023. And one of the things that jumps out is that we've spoken at length, probably for about the last 18 months, about the breakdown between the stock-bond correlation. And what's been really interesting, particularly towards the back half of 2023, was the amount of bond volatility that started to become prevalent. And in particular, that's off the back of expectations around markets. It's off the back of expectations around interest rates, inflation, etc. But bond volatility is at its highest than it's been in the last 15 years. So that in itself does create a lot of issues when you're trying to think through how you want to allocate your capital and if you want to use bonds or bond proxies. The breakdown of the stock-bond correlation, we've said this, we've published a paper. I'm happy to provide it to anybody that hasn't seen it yet. And we published this probably 18 months ago, that speaks about the fact that there has always been a relationship between stocks and bonds, but not in the way that people have traditionally thought that existed. And probably the last 20 years has seen it become an inverse relationship simply because of the very advocate-driven way of managing inflation with interest rates, and also interest rates being particularly low and where you source your alpha. That's something that we think historically, and I'm talking 100 plus years, hasn't always existed and is not likely to exist going forward. But one of the really interesting things that I would like to question, it's a shame it's not more interactive or that we're not in a room together, because I'd love to get a show of hands on this question. But can anybody remember the last banking crisis we had and who it involved? Yeah, it was literally 12 months ago, and yet it was like one never happened. We had 3 significant banks in the US go broke, but they were all bailed out, and the FDIC actually stepped in and said it was going to make sure that people felt certain about their deposits, and that averted what should have been, in other senses and traditionally would have been, a far more serious event for markets. And then from there, things just took off, and we've got that with the next point, talking about AI mania, or the Magnificent Seven, or whatever other phrase it's being given to it. But it's become a significant influence on markets, like major influence. If you were to actually extract those 7 stocks, and I'm sure you've all seen the stats, and it became the S&P 493 and not the S&P 500, then you would see that the market's actually not doing that well. You've got 7 stocks that are, I think by capitalization, represent something in excess of 50 or 60% or greater of the S&P 500. A lot of people are now starting to talk about how do you allocate to US equities rather than do it on a cap-weighted basis, which is how stock market indices are structured, is to do it on an equal weighted basis, and what that could look like for portfolios, and in particular to protect them as we go forward. The other thing is inflation. That's been a really interesting topic, particularly towards the back half of 2023. And as we say there, the death of inflation, I'm going to murder and by paraphrasing a famous quote, but the death of inflation has been hugely exaggerated. And that was also noticed towards within the start of this year. Markets were expecting rate cuts. They've been pricing them in. They've been pricing them in the way that they're valuing stocks, and also in the way that they're valuing bonds. Irrespective of what is being said by central banks, that we don't see interest rates coming off soon. In fact, they'd be lucky to be an interest rate cut before the end of this year. The markets have been pricing in 7 interest rate cuts this year in the US, and quite a few even here in Australia. Yet both of those central banks have said don't expect anything to happen soon. And if it does happen, it's not going to be until towards the end of this year. And you can see that last point just covers off what I was saying about the rate cuts. So our view is that markets are overexcited, they've overreacted, which is what usually happens in periods of exuberance. And there will always be sharp reversals, rallies, etc. And I think at this point, it's probably worthwhile just touching on where the fund finished the year, because I think that's important in the context of what I've just spoken about, to highlight that through second quarter, third quarter, and even into October of 2023, the fund was very strongly performing on its own right, but was also outperforming the S&P 500 and the ASX 200 considerably. Then we had that 6 weeks towards the end of 23, started middle of November, went right through basically until New Year's Eve, where equity markets went on a tear, particularly in the US, and also currency, with the Aussie dollar strengthening of nearly 10%. And then you also had bonds rallying incredibly strongly. And that's something that is unusual, first of all, to have all those 3 markets. It also makes our own point in 2 about the stock bond correlation breakdown. But what it also means is that a fund like LAIF is not positioned to take advantage of traditional markets and their rallies. It's there to protect your portfolios against all events, but in particular, when those markets rally, we're not going to go up by the same amount, but when they fall or when they suffer, we will still expect to have positive returns and preserve capital. Now, the return for the fund in that last 6 weeks was down about 3%. All of our managers did what we thought they would do. We were very pleased with the performance of them all through that period. Currency was a key contributor to the underperformance of the fund, because we have a portion of it hedged, but we don't have it all hedged. And that drove probably 70% of the overall decline in late November into early December. That doesn't concern us, because we were of the view, we were talking to a lot of people in the market at that time, and it's transpired since then that rally in the Aussie was going to be short-lived. It wasn't something that would be sustainable, and all the metrics were pointing towards a stronger US dollar than what we were seeing at that point, and that's transpired since. So we've seen the US dollar come back down to around 65. So I think it was even around 64 a few weeks ago, but 65 and a half is something that we're very comfortable with. And then we've seen, and we've just published it today, that the fund did capture not only the currency improving to where we thought it would improve, but also our underlying funds all did really well. And so we were up 2.36% for the month of January, which is a very pleasing result. And we're also, from what we've seen month to date, even though it is early, we're reasonably confident with the way the managers have continued to perform through February and how that will reflect in the fund's performance for the month of February. I'll just move on to something else that I think now is worth highlighting in the context of how the fund's performed and what you can expect from an alternatives allocation, particularly an actively managed alternatives allocation. And this slide is really interesting because it shows that active management, and if it's hard to see, I apologise, but it's a really interesting illustration of active management being a real skill, and you need to be able to exhibit that not only day in, day out, but year in, year out. And you can see in the Aussie market, about 81% of active managers underperformed the index. In the US, it was 87% have underperformed the index. And in Europe, it's actually staggering, sitting up there at 93.5% have underperformed the index. Now, on any measure, and I haven't actually put it in here, but on any measure that you want to use over the last 5 years, LAIF has outperformed all of those indices. So I think, again, it's just really important to emphasise not only the benefit of active management, but how do you continue to get alpha and the exposure to active managers who can create that alpha for you. Because you are going to ride, if you're not actively managing things, you are going to ride out the storm. I just ask whoever's just joined, please, to put them on. Thank you. Now, moving on to the next slide, something that is starting to get us thinking is obviously the rally in the Magnificent Seven, but also just more broadly what it's doing in markets generally, and what it's doing to investor sentiment and how it's starting to distort, I suppose, portfolios to a degree, particularly those who don't have exposure to these 7 stocks. But one of the things that it's done to the S&P 500 is it's distorted its performance. And if you look at this chart here, what we're highlighting is that since, and we've done this over a very long period of time to try and get a better establish what you can expect to see. And what you're seeing there is volatility had a fairly traditional relationship with equity prices on the S&P 500. But however, that started to break down in the last probably 18 months to 2 years. And it's one of the things that's guiding us when we're positioning the portfolio is this breakdown, the amount of complacency that this VIX index is showing investors have. You know, we're sitting down at a VIX of, I think 13 has been the average this year. I think it spiked to 17 about 2 weeks ago, but it's drifted lower again. But still, anything under 20, when the market is going as high as it is something that concerns us from the point of view of the where to from here. And the other thing that's worth noting from that slide is that, you know, you look through the period of the tech wreck, you look through the period of the GFC, you can see where volatility, you know, really did break away from the markets and stay elevated as those recoveries in those markets took place. And the other thing it highlights is that, you know, for a very lengthy period of time, the markets basically didn't perform at all. And that's something else that, you know, we're probably losing a bit of sight of with the exuberance that's being exhibited by investors in equity markets in particular. If you were to be a believer in mean reversion, which is something that I do, and I think only from the point of view that it does guide us to what we can expect when things happen, because when there is a significant event, markets overshoot. They either go up or they go down more than they should. What this, for the same period as the previous slide, exhibits is that, you know, and the Aussie market's not as is not exhibiting the same sort of exuberance, and that's driven primarily by those 7 stocks that we've spoken about in the US. But even still, if you look at the US, and yeah, you don't necessarily have to think it's going to be 60% down from here, but what it's really highlighting with this slide is that there is the likelihood, if a significant risk event takes place, that there's going to be a serious pullback in markets. and what could that look like? And the same in the Aussie market. You know, it says down 7% from here, but the Aussie market volatility based on this mean reversion calculation is still 16, 17. So that's still expected to be a fairly sizable movement down. And I think the next, oops, I think I've gone too far there. Yep, the next slide shows what would you expect to happen if you had a one standard deviation move in the S&P 500 versus LAIF, for example. You know, LAIF's annualized volatility sits at 7%, the S&P 500 sits at 18%. So one standard deviation move is basically saying it won't necessarily be 60% down, but a 20% down move in a short space of time is not an unrealistic expectation just based on where markets are sitting at the moment. And that's something that, you know, really does impact our portfolios. And in reference to the earlier slide, even though the Aussie market maybe doesn't have the same level of breakout as the S&P, one thing that you've probably heard is the saying, if America sneezes, Australia catches a cold. So that's what you'd probably expect, is that if whatever the US does, we tend to mimic. If they're down 10%, we're down 10%. So I think it's the purpose of using these couple of slides is just to illustrate that how we're positioning LAIF, what we're thinking about in the market, the types of things that inform our decision making is this sort of behavior and what we can expect to see. And you probably saw that to some extent in the way that the July through October period unfolded in 2023, and then the way the last 6 weeks of the year unfolded. You know, reversals are fast, up and down in these markets. Won't stay on that one because I've just noticed I said this would be a sharp update, and I've already been speaking for 20 minutes. What we think you can expect in 2024 and how we're positioning the portfolio to take advantage of that is that equity market volatility will probably become more prevalent, something that people will talk about more. It's something that we refer to as mean reversion as a way of just to contextualize it for ourselves, because long-term trends are important. And by long-term, I'm talking very long-term trends, not 5 years or 6 years, but 30 years, 40 years, because they are really good indicators of what goes on. And cycles are shorter than they used to be, but we still do have cycles. And there's some things that are going to start feeding into those cycles that we want to make sure we're positioned for. So volatility is one of them. We've got 2 strategies in the fund that are specifically allocated to take advantage of volatility. And they've both been doing what we thought they would do and better for us. We've been in them since March, April last year, and they've done exceptionally well for us. So much so that we've increased our allocation in January to one of them. And the other one we think we're probably right-sized for at the moment. The long-term trend, reversion to the mean, that's where our long-short funds are really going to help in this scenario. And it's something that we think we need to position the portfolio for. And talking to our long-short funds, it's something that, while not specifically thinking about it this way, it's what gives us comfort when they talk about how they're positioning their book, particularly their short book, and what they expect to come from it. The other thing is interest rates. Interest rates, inflation, are real pain points that are something that are going to become, I think, more serious as the next 12 months unfolds, particularly in the US. And we've already started to see some very big investors in this space either close their portfolios for redemptions, or in the case of one that I saw recently, making some reasonably sized markdowns in prices. And that, from our perspective, is not going to get better from here. If anything, it's probably going to have more pain moving forward. And there was also just a release last week from NAB on their quarterly cash earnings result. Didn't really get a lot of press, but my reading of it was interesting, because one of the things that we've noted for some time is that the banks aren't really feeling any pressure in the home loan or the business lending market. But what the NAB result highlighted was they've actually taken some significant impairments for the first time in a while to the bottom line. That to me is a sign that potentially they're positioning for the market to expect to see something else come through. And NAB are the biggest business lender in the country, so they would probably be likely to reflect this first. The other thing we're thinking about is higher for longer. Interest rates will stay higher and inflation will stay higher. than the market is currently expecting. And again, we're positioning the portfolio to take advantage of that. Some of it directly through a long short fund or a vol fund, or our trend following strategy, but others by staying away from that thinking altogether through our allocations to our decarb or our carbon futures fund, for example. And then, yeah, peak rates and inflation. Well, we might be at peak, but as we say, we're probably going to stay pretty sticky on both for some time to come. Now, I'm happy to pause there and see if anybody has any questions, because the remainder of the presentation is only really talking about the performance and things that you may already have. Pardon me while I just try to navigate this. Okay, so if you have any questions, there's a Q&A button at the top. Feel free to click on that and type your question in. We've got another 5 minutes, or I'm happy to keep talking. I won't ask anybody to vote on that one, but I don't know I'm just trying to think of things that we've heard or seen. I think if you were looking at alternatives and you were wanting to think about them as part of your portfolio allocation going forward, there are ways that you can obviously include it in portfolios. One of the things I would remind you to consider is liquidity. We are a liquid fund. We provide monthly liquidity to investors. What that also allows us to do is to be able to be quite active in the way that we adapt, because 80% of our, or at least 80%, if not more, of our portfolio is allocated to liquid investments as well. So we're able to move fairly quickly when we think the opportunity is right to do so. The other thing about the fund that I think is important to reiterate is I showed you in those earlier slides the volatility of equity indices, and I spoke about the volatility of bond markets, and not to mention the volatility in currency markets. But when you've got volatility in the US at 18% and Australia at 16%, and you can actually have an allocation to an alternatives product that gives you long-term performance, sitting above 10% in the last 3 years, and also gives you volatility that at the moment sitting down around 6% and has consistently been under 7%, then that's a really important strategic decision when it comes to structuring portfolios, particularly in times where, as we feel and as a lot of people are talking about, it's actually uncertainty that seems to be dominating the scene at the moment. When you listen to macroeconomists and other research analysts, one of the key things that we're picking up on is the amount of uncertainty that exists in the way that they're thinking about the market and in the way that they're forecasting, or in some cases not forecasting at all, what they think the market's going to do. So there are just a couple of other thoughts to think about. Also, we're very happy to take questions after this. Contact Elva or myself, and ask us if there's anything specific that you would like to have a broader discussion on, particularly around your portfolios. One of the things that we're prepared to do for people that we deal with and engage with us on our fund is to just maybe provide some insights on some of the ways that they can structure portfolios. We've got some great software behind us, and that's something that will allow you to also get some insight into your portfolio and where it might sit and what some of the correlations, some of the risks are, and so forth. And it's been a good exercise for those that have taken advantage of it to actually see, selfishly I'll say this, but to see how alternatives can, for no risk or even lowering risk, for no increase in risk or lowering risk, can actually add alpha to a more traditional type portfolio. So I don't have anything more I think I need to say. No questions have come through, which means that I've either done a really good job or nobody's listening to me, but I'll just hand it back to Elva.
Definitely listening. I think one of the my favourite part about listening to alternatives is I'm always learning it's such a big, broad sector, and it is one that advisors cannot and really don't navigate on their own. One, because their focus is on so many other traditional parts of the portfolios, but because the alternative space is so big. So thank you for taking the time to give everybody an update. I'll be in touch with each of you. I wish you a fabulous day and the rest of the quarter. And we'll be in touch soon. But thanks very much for calling. calling in.
Thank you, and I'll just end the call now.